Looking to plan a business event, but not sure where to start? With over 15 years of experience, Captivate Events is the expert in event planning and execution. Our dedicated team are specialists in business events, including gala dinners, exhibitions, conferences, seminars, overseas study tours, and more. Let us take the stress out of event planning whilst delivering an exceptional experience for both you and your guests. Visit www.captivateevents.com.au or call 02 8866 2440 and find out how we can captivate your audience.
This is a Momentum Media production.
The SMSF Adviser Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hello and welcome to the SMSF Adviser Show. I'm your host, Keith Ford, joined as always by my co-host from Smarter SMSF, Aaron Dunn. How are you, Aaron?
Very well, Keith. How are you?
I'm doing well. Nice busy couple of weeks. There's been lots going on. We've had, as everyone will hear a bit later in the podcast, there was a lot of news coming out of the class benchmark report that they put out annually. Some very interesting SMSF-related figures and numbers and research and all of that, which everyone can hear a bit later on in the pod from Tim Steele and Jo Hurley. But also, what's else happening in the world of SMSF?
There certainly is. And as is always the case, we kick off our first part in what's making news. So I'm going to hand over to you.
Yes. So what we have first, the big story for the last week or the last fortnight as it is, some gnarly changes hit Parliament. As Daniel Butler and Bryce Figott from DBA Lawyers mentioned in a piece that's on SMSF Adviser, it was kind of buried in the Treasury Amendment, Treasury Laws Amendment, the bill that was put through last week. But there's some guidance in there on the changes to gnarly provisions, and I'm not going to even pretend to understand them in a way that I can explain them to the audience. So I'm definitely going to leave that part up to you, Aaron.
Yeah, so whilst it might have been sort of covered within a bill that caught up a range of small business and other measures, I can tell you it hit most of us specialists smack bang in the eyes, right in the middle of the eyes, because it was what we've been waiting for, of course, in respect to the way in which the government was intending on legislating the proposed changes that they had previously announced earlier this year. We have, of course, gone through a myriad of change and discussion for a long period of time, and the government has, of course, settled now on a 2 times multiple to determine what would be a non-arm's length amount when it relates to general expenditure. So in essence, that is what we have now seen introduced into Parliament. So a lot of the discussion that has occurred from within the industry, whilst not a lot of people in the industry were really endeared with where it's landed, the reality is this is what it is. And we now have this carve out, in essence, for SMSFs around how the non-arm's length expenditure rules will work. And again, just to reiterate to everyone, this only applies in respect to the connection of the general expenses to all of the fund's income as opposed to specific expenses. These measures are intended to revert back to the introduction of the legislation in 2018. But we still have our overriding safe harbour or the PCG, where the ATO will not apply compliance resources through to the 1st of July 2023. So it is expected now that this will probably go through unchallenged, and the ATO had previously indicated that they wouldn't be looking to make any further concession on that PCG historically, and that certainly now seems to be the case. So a good reminder for accountants, advisors, and so forth that have their own self-managed super funds, the importance of understanding what hat you're wearing when you're doing some of that work for your own fund. Are you acting as a trustee or are you actually acting in your own individual capacity where you have the necessary skills and so forth? And we've even seen in recent times a couple of interesting private binding rulings go through the Australian Taxation Office, and the facts and circumstances of each of those, both in respect to the accounting work being done for the fund have come out with two very distinct and different outcomes. One would get caught under these gnarly rules and one actually wouldn't. So again, just a really good reminder for accountants and advisors and so forth to be getting yourself aware of how these rules are going to apply and what changes you might need to make to your own circumstances and those that might be related around you, that you might also be assisting in getting that work done.
As you mentioned, it's part of a larger bill. It's not the only thing that's included. It's probably going to pass through as is. There's unlikely to be major changes. It's not anything terribly controversial wound in with it. It's just a lot of small business aid stuff like the $20,000 instant asset write-off, the small business energy incentive, things along those lines. It's not something that we kind of really expect to be controversial and cause a big stir and get a lot of mainstream attention. It's certainly more the niche business focused stuff that's going to be looked at.
Yeah, correct. Yeah. I mean, the only controversy, and we've spoken about this on here previously, is the fact that, we have a piece of legislation here now that will be introducing into the non-arm's length income rules a framework that will apply solely to SMSFs and small APRA funds. When we think about that $3 million threshold that we've been speaking about previously, they don't want to create a separate set of rules for SMSFs and small APRA funds. They want to keep everything together. So they are literally trying to have their cake and eat it too.
As always, everything comes back to the $3 million super cap.
Yeah, correct.
Well, actually, fairly in line with that, we've got the next piece, which essentially was the Institute of Financial Professionals Australia telling the government to keep its hands off super, is essentially the message there. So they've been talking about $3.5 trillion of superannuation savings and looking at the objective of super and some of the wording within what the government has put out, specifically looking at the way that the government perhaps sees the super system as a source of capital for the economy. And the IFPA, and specifically Natasha Panagis, who's the head of superannuation and financial services there, she said the government was not shy about those plans. So what was your take on this, Aaron?
Yeah, I think at the moment, there's obviously an opportunity for feedback, again, around legislating the objective of super. So we have an exposure draft. We have not only seen, submissions sent previously, but we're seeing submissions and concerns raised still. And I know the SMSF Association recently raised a couple of issues as well around the definition of that, or that definition within the objective of super, and thinking about the way in which some of the terminology is utilised and measured, in essence, as we go along, given that it is quite subjective, some of the terms that are actually in there about, standard of living and the like. So, it's kind of, it provides that getting that objective right is then ultimately going to set the tone for a lot of the policy coming forward. So quite clearly, we'll have different organisations on different sides of the superannuation landscape that will have different views in respect to the way in which the narrative should be applied by government. And there'll be others that'll be obviously quite supportive of that process as well. And it's going to be a pretty interesting sort of wrap up as we move towards the back end of the year to see how this lands and then what kind of follows from there on, in particular with that earnings threshold as well.
Yeah, and one of those things that kind of came up that Ms. Panagis kind of pointed out was very similar to some of the SMSFA comments around ring fencing of super to take care of aged care costs and things along those lines. She said, it's way too tempting for the government to ignore that $3.5 trillion, that it's one thing for the government to make sure that there are minimum drawdowns, but having rules around how people spend their super just going to add complexities. It takes it out of the hands of the individual. She certainly believes that this kind of thing will push more people into SMSFs, which I'm not really sure whether that's something that will happen, but it certainly, I mean, I wouldn't say it wouldn't do it either.
Yeah, I think one of the, when you you go back and you look at that, legislating the objective stuff, and we spoke about that in our last show, that whole concept of looking to hive off amounts to control for different purposes doesn't actually fit the way in which the explanatory memorandum tried to define the delivery of income and stuff anyway. So you'd like to hope that wouldn't arise. You can understand what the government is trying to achieve in some respects, but ultimately what the objective talks about in terms of delivering income really focused on the fact that it is the individual's choice. The retirement savings, the vehicle that is superannuation, is there and provides concessions to save for retirement. They're not imposing, or they don't intend on imposing, the fact that you have to draw it down as a pension. You may want to take that money out as a lump sum and then invest it in other circumstances, or you may look at a combination of these things. That choice is all about delivering income for retirement to meet the ongoing costs and needs of individuals at that later stage in life. And yes, it might encompass aged care, but there shouldn't be any focus on ring fencing for that. That's the role of, well, A, the individual's choice, and then B, what advice might be able to provide in the future. And that in itself is probably, one of the other great challenges of government is around, the access to advice of, or for that growing cohort of those moving into retirement.
Yeah. And I suppose the idea of choice is something that is so important in many people moving to an SMSF and having that kind of individualized experience and having a bit more control over their retirement. Yep. So I can kind of see how if you're limiting choice, people are going to go, maybe I want to go back over here where I've got more choice and can take a bit more of a bit more control over my own standards.
And they're the two things, right, that are key to SMSF, choice and control. So if people feel like those things are getting taken away from them, then the reality is they may look to seek out structures for retirement that give them greater flexibility, choice and control, which the SMSFs obviously come into their own.
For sure. So the next piece that we've got that we're going to talk about was some suggestions for super changes that came from David Knox, who is a senior partner at Mercer Australia. Their recent report, Rethinking Super Tax Concessions. Essentially in there, he floats quite a few changes, one of which is increasing the drawdown rate and halving the non-concessional contribution cap, which in Mercer's view and David Knox's view would all be positive for the superannuation system. So what are your feelings on some of the suggestions out of that report?
Yeah, so I think the main thing here is again, it's linking it back to this draft objective of superannuation. And when you think of the latter part of that objective, which is around equity and sustainability, he is recognising that the government has a finite amount of money that it can spend and make available on tax concessions. So a way in which we can certainly limit that is either A, by the amount of money that you can tip into superannuation, and B, potentially accelerating the rate that money needs to come out of superannuation as well. So the equity and fairness of those things is always going to be front and centre as we work through these stages. This rethinking the super tax concessions is timely in respect to why Mercer has put that there, because quite clearly the government would then be, once this is then legislated, would then actually start to think about ways in which, and once it's enshrined, would be, well, how do we actually move forward? Is there any changes that we're going to make? And therefore, when we want to measure this against the actual objective, because that's what the objective is all about. It's when we put policy forward, we need to have this put against the objective of super. Just like you have to put it up against human rights, and you had, as part of the bill that goes into Parliament, it is there to be tested against the objective. So in this way, when we look at, I guess, future policy, this is something that David here has put forward as a way in which that if they're looking to make changes, you would argue that these things fit into the box of equity and sustainability, but also continues to deliver income for retirement, et cetera, et cetera.
Now, there's a quick little part in there, and honestly, I barely believe it when I read it, and I want to almost make sure that I've interpreted it correctly. It's actually in favour of the $3 million super cap, which no one seems to be in favor of the superannuation cap, certainly anyone who's providing feedback to the government, but essentially viewed in the broader context of his suggestions, one of the things that he says is that these changes will reduce the level of super tax concessions received by those with significant superannuation balances, whilst at the same time retaining some concessions for valid reasons outlined earlier. Essentially, one of the little caveats is investment earnings. So I don't think he means assets. I think he does mean earnings on investments. But it basically one of the few people who has come out mostly in favor of the balance cap. So
yeah, and I think it's a broader statement. David's been around for a long period of time and seen the journey of what superannuation has provided for this country. The reality is when you look at the issue of equity, he's taking a whole of industry view and saying, well, in funds or members that have balances that are greater than $3 million, is it equitable that the tax concessions that are provided to funds beyond that fair in the context of those that may be getting very few concessions through superannuation, but might be getting concessions delivered to them through other government support, age pension and so forth. So when you think through that position of equity and then sustainability of can we actually afford to keep these concessions going, I don't think we'll see more people go, look, $3 million, yes, we've got to pay for COVID somehow. And maybe then we do need to look at ways in which there might be higher taxing points. The bigger issue is actually the formula in terms of how that legislation is applied. If the government took out that concept of unrealised gains within that legislation, you will find more people will come out and go, look, we might not like it, but you know what? That group, that cohort of people with balances above 3 mil, if they pay a little bit more tax on the money that has actually been earned in the fund, suck it up and move on, right?
But that is the thing, isn't it? It's one of those things where just because taxing unrealized gains is just so foreign to the rest of the tax system, that is a sticking point for so many people. And one of the other things that he mentions is that the cap should always be greater than or equal to the index transfer balance cap. So presumably, perhaps in the wider report, I haven't read the entire report, perhaps in there he mentions this more directly, but that would seem to indicate that he wants an indexed cap on the super earnings. So the $3 million would move with inflation. So
and similar
that's
with
basically addressing both of the big complaints about it.
Yeah, correct. And addressing the same sort of thing is written in there around concessional contributions. And we're getting to the point where the maximum contribution base is encroaching on the actual limit. So the concessional cap, and just making sure those things are obviously moving along with some level of cohesion as well. So, so from that point of view, in terms of thought leadership in this space, there's some quite interesting things in there. The reality is to me, the main issue is not so much the dollar value itself around that $3 million thing, but the calculation that sits within it. If you pay Div 293 tax, you're earning more than $250,000 a year. No one likes it to have to pay more tax, but it's a byproduct of the high level of income. They don't add in unrealized gains into your taxable income in that calculation. So, but that's in essence the analogy that you would use when it comes to the earnings thing here. And I guess, again, if the government can look to address that particular issue, they would probably end up with a hell of a lot more support than where they are currently at today.
Yes, I think that's a very fair statement there. All right, so we're going to take a quick break. And when we come back, as I mentioned earlier, we'll have an interview with Tim Steele and Jo Hurley from CLASS talking about their annual benchmark report. And that was recorded live at their CLASS Ignite event last week in Sydney. I'm joined now by Tim Steele, who is the CEO of Class, and Jo Hurley, who is the General Manager of Growth for Class. We're recording live at the Class Ignite event, where Class has just unveiled the 2023 annual benchmark report. Tim, Jo, would you like to give me a bit of an overview of what's in the benchmark report and what the key takeaways are?
That is a big ask, Keith, right up front. But look, I think there's probably a number of highlights for us that may be worth sharing. So one thing we've seen is this lovely consistent growth in SMSFs over the last 5 or 6 years. And we're now sort of seeing net establishments get to a point where they're as high as they were or highest they've ever been since the super reforms. And that combined with some increasing contribution rates, both non-concessional contributions and concessional contributions up 28% and 11% respectively for FY22, I think combined are a really interesting sign of the health and confidence of consumers and ultimately advisors as well in the SMSF structure and SMSF sector more broadly.
Absolutely. And so we've got a few of the key insights that came out of the report. One being that younger generations are actually driving SMSF establishments. That's, I guess, not a huge surprise that establishments are a bit younger, but the volume probably is. So Gen X, if I've got my numbers correct from the report, they account for 52.7% of all new establishments, which is a pretty significant proportion.
Yeah, it sure is. And when you combine them with millennials, we're sort of combined at 76 plus some decimal points in percentages, which is consistent with what we've seen sort of in recent years. And in fact, to be quite frank, it's actually down just very slightly, particularly for millennials. Gen X continued, I think, to drive that, but millennials just slightly down, but continues to be a really attractive solution for those earlier in their life. And we've seen this data sort of as a macro theme. We look back at some of the ATO data 2011 to 2021, which was sort of some of the more current data that was available on this. And, you know, the average age has decreased quite significantly over that period of time. And I think we touched on 61 to 54, I think is sort of it's 54 to 46, I think is the age range. There's been quite a material change in the median age of people actually establishing funds.
Yeah, I saw in the report that based on that ATO data from 2011 financial year through to 21, it was that 54 to 46, and based on the class numbers for the median age, it slightly increased after that from to 48 over the last year, I think, based on the report, which, I mean, it's still in that general range, but that it falls squarely in that Gen X demographic of who's kind of doing the most establishments.
Yeah, so I'd say what's most exciting for me when I see these heavy levels of Gen X and younger generations getting into SMSF is just the advice opportunities that come from that for SMSF professionals. When we think about, I guess, the maturing of the SMSF industry, we've been in this game for some time now, but it's been traditionally a space where, people get into SMSF quite late in their journey. And as a result of that, the planning opportunities and I guess that runway to retirement has traditionally been a lot shorter. And then it's been a real focus on playing catch up and kind of employing every strategy you can for them to get the most value of having an SMSF. For these members, Gen X and millennials, their runway to retirement is significantly longer. And that's really exciting, when you think about the advice opportunities over the course of their SMSF journey, to think about what their retirement outcomes are going to look like just purely based on the fact that they've engaged and made that decision to take control and set up an SMSF so much earlier in their life. And I did want to also talk about that stat around the median age slightly increasing from 46, 47, 48 over the last couple of years. And we do have a look at the millennials and say, okay, millennials may have backed off a little bit since the heights during COVID, but also it drove me to look further into the benchmark report and what else could be driving that. And it was a real revelation for me to see when we think about growth in SMSF, we think about new establishments. Where are the new funds coming from? But actually, the best explanation for that median age of an SMSF member rising slightly is to be found in the 75 plus category of SMSF members. And what we're seeing there is actually the fastest growth rate of an age sector across all of them. And what that's saying is that SMSF members are staying longer.
Yeah, which it's certainly the kind of result that it comes a little out of nowhere. You expect growth to come from new members joining rather than people staying. But if it's reversing a trend, it does kind of make sense.
It makes sense that, in terms of total funds and SMSF members, in order to achieve greater levels of growth, we both need to have new entrants, but we also need to, have members that are, sticking around. And so like that extension of engagement in the later years, well beyond hitting retirement age, I think is really exciting. And when I think of some of the regulatory change and opportunity that's come from a strategy perspective, it does make sense. You've got people who are nearing retirement who suddenly have, they don't need to deal with the work test, downsizer contribution opportunities. They are actually, the 55 to 65, they're driving the catch-up concessional contributions, and this significant increase in contribution rates that we're seeing, 28% in 12 months, is significant. It's really showing that engagement around the time of retirement and then actually staying in an SMSF well beyond that retirement is actually driving growth.
Yeah, and so that word engagement used quite a few times, and for a pretty good reason. It is a big part of the difference between a self-managed super fund and a normal APRA regulated fund. Most people who are going into an SMSF, they're going to be paying a bit more attention. They're going to be more engaged with what their retirement looks like. That's why they've wanted this extra flexibility, more control, things along those lines. And something that does kind of play into that was another finding from the report was with what's being called the reverse gender gap. Would you be able to explain a little bit about how that reverse gender gap has worked and how it kind of progresses over the rest of the member's lifetime?
Sure. So last year's class benchmark report, we took a close look at gender gap to see how SMSFs were performing against APRA funds. And we did have the insight and talked a lot about the fact that the gender gap in APRA funds was rising and that the gender gap in SMSFs was continuing to fall marginally. So we were seeing marginal improvement in SMSF. Again, a real indication of, the benefits of having an SMSF because that engagement of female members is higher and driving, a reduction in gender gap versus APRA funds where it's rising. What we did this year was extend our data analysis to look at the age, like the gender gap over the range of ages of SMSF members. And I let out a pretty excited noise when I saw a negative gender gap. And, for me personally, that was really exciting. I've never actually seen, data indicating a negative gender gap before in my time. And so what that shows is that in their 20s, women have more super in SMSF, in our SMSF data, than male members. Then what stands out is when you look at the highest reversal of that. So where do women, move from being ahead of men in their super savings to being quite well behind is in that 30 kind of plus age range. It's quite a significant reversal of this negative gender gap. That's like a double negative in a way. But essentially you've got like a really exciting news story, and then you can see in those times when career breaks are likely to be happening and women are heading off to have children, that in a short period of time, the gender gap builds very quickly. And when you flow that through the age groups, it never fully closes again. We never get back to gender equity or, the idea of a negative gender gap again. So that prompts the question, what strategies can we be, and how can we be working with women, particularly those women who are choosing to enter, set up an SMSF early in their working life? Because let's be frank, like the decision to start an SMSF in your early 20s is a pretty big decision. Hopefully we'll see more, family style SMSFs where maybe the parents and the daughter might be in their own fund. But we need to think more about the strategies that would encourage increasing that negative gender gap early.
Yeah. The number being, minus 4.1%, the gender gap. So I guess 4.1% in favor of female members, which is a big difference to the APRA kind of graph. It's in that same age range. It's around 10.8%. But on the graph, what you notice is that while there's that sharp decline around that career break stage, it then does kind of come back down. It settles below the APRA one, but as you said, never really gets close to having any measure of parity between women's balances and men's, which I guess kind of shows the value of having super all the time. That break in contributions can really have a huge effect, which is, it's just pretty interesting, I guess. So what I kind of want to ask is, where do you think that, what's driving this more than anything, and what can be done to kind of keep the foot down, keep the measures improving?
Yeah, I like that. Keep the foot down, keep the pedal to the metal. That's my kind of language. Those of you who know me will agree. Look, what it's really saying is, and when I think about the strategies that we tend to think about in terms of closing the gender gap and dealing with this issue, is they tend to be quite late in the piece. So we look at rebalancing strategies, and it's great to see that advisors are really adopting those rebalancing strategies, looking at downsizer contributions. I mean, females outstrip males when it comes to downsizer contributions as well. So yes, advisors are doing their best to close this gap later in life, but due to compounding and just the value of time, it is really clear that if we can get ahead of the curve and think about ensuring consistency of contribution during career breaks, so whether that's, maternity leave, career break, like those kinds of things, to actually think about salary sacrificing, making voluntary contributions, using contribution strategies at times when earnings are higher. So, there are going to be plenty of times where, the female returns to work, their income accelerates quickly, making sure that there's a solid strategy to pick those habits up immediately and get the contributions pumping. Those kinds of strategies are most likely going to be the ones that close the gender gap for good.
Right.
And just fair to say, so much of this is education. So if we're able to help the industry more effectively articulate some of that, what's effectively a maths problem, right? Yeah. So, the power of compound interest, we know if you get more money in earlier, that can have a profound impact. And so we could be able to quite simply show with some simple modelling that if you put an extra $1,000 a quarter in for the first 5 years of your career, even if you choose to have a break at some stage later in your career, say in your mid-30s, what's the impact of that in creating a long-term nest egg for your retirement? And so I don't think people are making a choice not to contribute. I don't think they're even thinking about it. And it's a small percentage. And in this case, certainly females earlier in their life seem to be thinking more proactively and sensibly about it. They're being smarter about it. But it's a very small number, I think, who are truly educated on the benefits and impact of that.
Which does probably explain why in an SMSF where you are a bit more engaged, it's finding this more than the APRA funds.
That's right.
I mean, when you said that in APRA at the same age it's 10%, that's a 14% difference between women who are in APRA funds and in SMSF. So that actually does go to show the value of advice early and what SMSFs truly offer in terms of the value of that advice. And also the value of member engagement.
Yeah. And if they are in an SMSF, they may have, there's probably a much more likely that they will have received some measure of financial advice. It's not something that you would go into without consulting anyone. I don't know if anyone does that. I can't imagine that would be a good idea, doing it without talking to anyone. You should probably know what you're doing.
Yeah, I always recommend getting specialist advice. SMSF specialist advice is so important. In fact, I've been in this industry my whole life, and I have advisors that help me with my SMSF, and I make sure they're members of the association, they're SMSF specialists. I've always done that because it's even the value of just, for me, that independence and another fresh set of eyes on what I'm doing. Even I would not look to do it myself without someone like that holding my hand through the process.
Especially if you're 25. One of the other findings that was pointing out some points of difference between APRA funds and SMSFs was to do with the proportion of members that are over 65 and fully in the accumulation phase, which for SMSFs, that's only 1 in 8. For APRA regulated funds, it's 1 in 2, essentially. I think the number was 49 point something for APRA funds, which is just a bit of a huge number when they're over 65. It is surprising that there's so many that are fully in accumulation. Would you be able to talk a bit about what's driving that and what you think it means?
Oh, I think this is big. I think this is one of the more profound insights that comes out of the data, and we've seen more recently there has been a bit of noise in relation to this particular issue because we know there's now an obligation on RSE licensees, APRA-regulated funds, to adopt and employ strategies to help retirees to optimise their outcomes, a retirement income covenant. And, APRA and ASIC's combined report in July sort of indicated there's probably a long way to go on that front. And this is a really profound data point. So 1 in 2, we believe, are paying tax that they need not be paying had they understood, be better engaged, better educated on what their options are. And I think that is the stark difference. It's education, it's advice, it's the obligation on trustees to have contemplated cash flow as part of their investment strategy. And so we just think SMSFs inherently, because they're more engaged, have actually actively made a choice to commence a pension, whereas our suspicion and hypothesis is that, in APRA funds, members just are perhaps less engaged, and so therefore they haven't made a conscious choice one way or another, and they certainly don't understand the implications. It's also effectively a hidden cost, right? So there's no big tax bill that comes on their member statement that says you've paid this additional tax you need not have paid. It's actively embedded in the costs. And so I think that's probably one of the other issues, is that we need to help them, make them more aware of what their options are. But I would say both ends of this are really quite interesting. If you think about the reverse gender gap at sort of early 25s, that I think is a direct result of heightened level of engagement. And I would say similarly, this data point around the stark difference between APRA-regulated funds and SMSF funds in terms of those who've actually commenced the pension post 65 is also, I think, directly correlated to the level of engagement.
And certainly it would seem indicative of whether they're receiving financial advice. If an advisor's looking at what they've got in super and they're telling them you can save yourself a lot of tax by going, moving into retirement phase, they probably would have done it. So having access to advice has to be a big component of this.
Absolutely, no doubt. So we're convinced that we know the SMSFs are more likely to be advised and that they've received advice to say you need to commence a pension. So it, in one sense, is the greatest advertisement you could have for the value of advice, is just looking at the relative tax savings for someone in retirement, or at least at that stage of their life where they could have commenced a pension and perhaps opted not to, or in most of the majority of SMSF cases, they opted to.
It does also a bit of interplay with this is the proposed $3 million super cap, which, of course, very topical, very controversial, a lot of opinions. A lot of people get very fired up about this topic. One of the findings from the report that is that it, and perhaps unsurprisingly, it affects older super fund members at a much higher rate. It, of course, affects SMSF members at a much higher rate than APRA fund members. That's been well documented. I believe the number was 5% of class SMSF members have balances that are in excess of $3 million as of the reporting cutoff date, which was the end of the financial year. Another 4.7% of class SMSF members have balances between $2 and $3 million. And why that's important is because at the moment, the $3 million super cap is not planned to be indexed. So these are another cohort of members that will then be affected further down the line if that number's not indexed. So would you be able to give me a little bit of an understanding around how you think that the super cap is going to affect those older members and what it means for, I guess, SMSF members in general.
Oh, look, I think we've done the analysis, so we know that 78% of our members who have $3 million or more in their accounts are over 65, so they should be in pension phase. So I think it'll cause them to think about how they might manage their SMSF and what they would need to do to try to minimise the tax impact. We don't think it's going to lead to a material change in the way people think about establishment, because it's still, as I think Meg Heffron so well articulated this morning, it's still such an aspirational number, $3 million. And I don't think many people start out saying, but that'll be a problem I worry about. What a great problem to have is I've got too much money in my SMSF fund or my super fund, and so therefore that's impacting me. I think the $3 million cap is a challenge that needs to be dealt with. Our view is that it's probably a solution for a temporary problem when you look at the demographics of those, in our case 80% being 65 plus. There is a natural endpoint over time when that will no longer be an issue. We've already dealt with the mega funds through contribution caps, so we're not going to see mega funds again into the future because of that. So we would say it's probably a solution for a temporary problem. I think taxing unrealised gains is a more problematic issue. And we did some analysis to attempt to identify what proportion of those clients over 65 actually had property in their SMSF, and that was about a quarter. And so that creates different planning complexities, I think, when you have, assets in your fund that aren't easily liquid, easily valued, and how do you think about dealing with the complexities of both valuation and then potentially paying tax on that gain if you don't have the cash flow to support it. And you think about scenarios where people might have, farms or perhaps, their commercial properties in their SMSF. It's a really complicating issue that I know the SMSFA are passionately looking at and attempting to lobby and bring some data to Treasury to help shape their thinking. But that is probably one of the bigger challenges from a planning point of view.
Yeah.
And I will say we've picked the theme with change comes opportunity.
Right.
Very deliberately. And I think already at Class Ignite, we're really seeing some really great thinking around strategies to deal with this potential change. And that's what the SMSF industry does so well and offers to our members is we talk about engagement. Not only are members, trustees, engage in SMSF, but the advisors who are looking after them are heavily engaged in thinking about strategies to help our clients to manage through change. And I am really loving the opportunity to continue learning and thinking about ways that we can use all of the strengths that we have in SMSF to help our members kind of plan ahead, to have a think about what this means. And also the opportunities, I think, for advisors to take a more holistic view of their clients' wealth across, I guess, multiple vehicles as well. So we do see that there's an opportunity around potentially the growth of trusts and, basically taking that view that SMSFs are just one part of a wealth picture, essentially. And the advice opportunity is there to have a look at the SMSF, not in isolation, which is often a mistake that's made when we look at SMSFs in isolation and make assumptions around investment strategies and different things. But when you look at it as part of an overall wealth picture, that changes the narrative.
All right. Well, thank you very much for your time, Tim and Jo. I think there was a lot there that was very interesting, a lot for advisors and SMSF members to kind of get their head around and some interesting trends that were covered. So thank you very much for joining the podcast and hope everything goes well with the Ignite event.
Thank you.
Thanks. Great to have you with us.
Thank you.
All right. Welcome back, everyone. I'm joined once again by Aaron Dunn. We're just going to do a quick little wrap up of the week and what Aaron's most interesting piece of news from the week was, and I think I can guess.
Have a guess. Go for it.
I think it's going to be the gnarly measures.
Yes, absolutely.
Yeah.
So we've only been waiting since 2017. So, if you've been waiting that long, it has to kind of rank as the highest one there. Of course, it's got to go through both houses. I suspect it will. And then, as I said in the start of today's show, It's really about getting the house in order on some of those things. Yes, there are other elements to those gnarly rules around specific expenses, but a lot of the requirements with that, you needed to be really having your affairs in order already. So, yeah, to me, that certainly is the most important part that I've seen come out in the past fortnight.
Well, my most important one, something we've not talked about yet.
Yep.
The finalists being announced for the SMSF Awards. That's, of course, my most important one here. We've got all of the categories now have their finalists announced. Anyone who wants to see who the finalists are, they can go to the SMSF Adviser site. We've got 15 categories there. You might see Smarter SMSF on there somewhere in there.
Not once, but twice.
Twice, of course. Yes, I can't shortchange you.
Yeah.
So the event that we're going to be having, it's going to be a live stream announcement of the winners. That's going to be occurring on Wednesday, 1 November at 4 p.m. So anyone who is nominated, you'll need to make sure that you are paying attention. Keep an eye on SMSF Adviser for all the news. Anyone who is a finalist will get personally contacted as well. They don't just have to rely on me on the podcast. That would be a terrible idea. But that's happening on the 1st of November, Aaron.
Yeah, absolutely. And again, it's great recognition of all those that have made the finals, of the work that they do within the industry, and to everyone that voted, not only for me, but for everyone, obviously, through the events. A big thank you as well. And of course, Keith, it'd be remiss of us, as we do each and every fortnight, it is getting closer and closer and closer, our SMSF Adviser Technical Strategy Day events.
It is. It's certainly getting closer. We are within a month of the first event in Sydney. That's on the 17th of October in Sydney. 18th of October is the next one in Brisbane. And then the following week on the 25th of October in Melbourne. You can see Aaron in person or via a live stream if you are not in one of those states and are unable to travel to one of those events. As we do every week, we encourage people to get out there and actually go to the live event. But of course, not everyone will be able to make it. So if you want a live stream, that's also okay. We've got a lot of great speakers talking about some very interesting stuff that will illuminate a lot of topics for people. And that's our Technical Strategy Day, Aaron.
Absolutely. Yeah. Again, can't sort of reiterate any further that what you just said, Keith. It's a great lineup, great topics. We're obviously seeing some of the rubber now hit the road with some of the topics that will obviously be spoken about at those events as well. So go to the SMSF Adviser website. You'll find the Technical Strategy Day and you can register. As is always the way then, as we wrap up, Keith, if anyone has any suggestions around speakers and topics, how can they get in contact with us?
Of course, they can contact us at editor@smsfadvisoronline.com.au and we will hopefully listen to your suggestions.
Hopefully. That's great. Thank you once again, everyone, for joining us for this week's edition of the SMSF Adviser Show. Hope you have a great rest of the week and we look forward to you joining us for our edition in a fortnight's time. Take care and bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
If you're an SMSF advisor seeking to enhance your skills and knowledge on the evolving Australian superannuation landscape, then the SMSF Adviser Technical Strategy Day 2023 is one event this year you don't want to miss, with specialist-led sessions detailing all policy and regulatory changes, best practices when approaching estate and succession planning, and tools to navigate complex SMSF property investment issues and more. This one-day event held in Sydney, Brisbane and Melbourne in October is your one-stop shop to gear yourself up for success in the year ahead. Limited tickets remain. Visit smsfstrategyday.com.au to learn more about the event, our specialist speakers, and to secure your ticket before they sell out.